All right, we're live.
We're live. Thanks, Chris. Today is September 17th. I am Ryan with East Main Street Insurance. As always, my humble co-producer, Chris Kumar with Cobalt Insurance. And we are House Calls, home insurance podcast, bringing you up-to-date information, up-to-date insurance rates, up-to-date insurance carriers, and then just helping you get access to a couple brokers who can help you with answering questions and finding out what's going on in the market. A lot of interesting stuff out there this week.
Yeah, we got some good stuff to talk about, huh?
Oh my gosh, between legislation, some new carriers, I don't know if there's any news, any mergers or acquisitions or anything crazy like that, but
I'm just checking to make sure our lives went live. But yeah, I hear you. I'm agreeing.
I'm gonna
no idea what's going on here.
While you're doing that, I'm gonna just do a quick time and temperature check on the insurance Department of Insurance and seeing kind of if there's been any rate filings and what that looks like.
Cool.
So I'm going to share my screen. And as always, This is public knowledge for everyone. So hopping into the rate filings just to see what's been approved. It's done every week. We can kind of see which carriers have said, I want an extra 7%. I want an extra 30%. I want an extra, or I want to take a deduction because I've got some good business and I want to saturate correctly. So sorry, I got to share a different section because it goes to an entire new location after you pull the report. So right off the bat, homeowners safety pays program, 44% with American Family. That is a homeowner's rate increase.
With American Family, huh?
Yeah. Safety pays. So there's probably going to be some sort of crazy, maybe wildfire hardening discount option. The way that I think I've shared with you too, is this is where the SURF number is right up here. And then you go to SURF and then you can see all the filings. You can see all of the data they have to provide to the Department of Insurance. So that's good. Looks like general liability, commercial package, general liability. Looks like a lot of general liability stuff. Oh, here's commercial auto, 44%. Again, these are averages. So the way that insurance carriers work is this is your average. Some zip codes will see higher, some will see lower. But that is it as far as what's gotten approved.
Nothing too big, right? Nothing really changed.
Nothing too big. No, not at all. Other than just that American Family.
Live on all of our channels.
Nice.
Which is great. And
so
I guess we'll go forward with our presentation we put together.
Okay. I guess we do have one person looking. So if you have a question or a comment or want to ask us anything, the floor is open. It's an open podcast. We're here to answer your questions. So feel free to text in or comment on one of the links that you're on, whether it be Facebook or YouTube, and we'll be able to see that and answer your question.
Cool. So let's see here. I'm on this screen. Sorry. So we got 3 topics today, right? We've got you've got some really exciting news actually. You've written quite a few policies too, right, with this new carrier?
so far so good,
Great.
which has been pretty
So-
nice.
So, as we've said in prior podcasts, not every independent agent has every single carrier, and Ryan has a new appointment with a carrier that is taking higher fire risks.
Yeah,
I'm
they'll
gonna let
take
you go through
take
the
everything
slide.
up to a protection class 10.
Oh wow, I thought it was PC9.
Well, PC9 or protection class 9, yeah. So if you're a protection class 10, which it's hard to be a protection class 10, but there's a lot, anything that's usually over, I want to say probably 10 miles, definitely over 5 miles from a fire station, and then does not have a hydrant, you have a higher likelihood of having a higher protection class code.
Yep. So going to the next slide, and it's pretty straightforward what we're going over as far as who would qualify for this new carrier. I'll let you run through this.
Okay. So they will only take owner-occupied risks. There's no rentals. I have actually already got a secondary booked with them, so they will do owner-occupied and seasonal or secondary homes. Has to be at least built in the 1900s or later. And then also have to have those updates to the home with the plumbing, the electrical, the HVAC, the roof, and the roof has to be architectural shingle, tile, metal. Let me see what else. The safety systems, yeah, it must mean in the electrical and plumbing codes because there's still a lot of Zinsco, Challenger, Stab Lock. Trying to
So
think of
primary or secondary residence. So someone's got a home in Truckee. It's in great condition, meets all this criteria. It's their vacation home. No problem unless they're Airbnb-ing it out for a portion of time, right? Then that's not that's a no-go.
Any rental exposure, they will not like it.
Okay. And then you'd already gone over most of this, but I think this just gives more detail.
Yeah, foundations, approved roofs,
Yeah.
pools. So the pool does have to have no slides, no diving boards, has to have at least 4-foot perimeter fencing around it to be eligible for the pool liability. If you don't have that, then you will not get pool liability. So
that's a great thing. So let me clarify. You could still write that property. It'll just exclude liability for the pool.
Correct.
Okay. That's better than not having an option, right?
Yeah. Yeah. I think people want to know, if you can go ahead and take that or not, like with the pool.
Mm-hmm.
Because some people don't have the slides or they don't have maybe the locking cover. I think diving boards are really starting to, slides are phased out. I think everywhere. I haven't seen a slide in a long time.
Mm-hmm.
Diving boards, though, a lot of people still have those in their pools. So have to take that out.
Yep. Might save you a few $1,000s a year.
Yeah, it might be worth it.
Moving to the next one. That's all we had on this carrier. So I had very sparse material. I'm trying to get the same appointment you are, but right now you're having great success. You're quoting a number of homes and writing a number of homes. So
yeah, and I guess just they do inspections where after you bind the policy, they put it on the consumer. So you will get a link to do the inspection, to take your photos, upload them up. So far,
no third-party inspection. They're just having the homeowner provide that information.
No, they do allow that. They do allow field inspections, so you get the choice.
Okay.
But most people are pretty savvy. They can take a photo with their phone and submit it directly up to the carrier. There are, I think, a few carriers that only do that. So it's probably going to be industry-wide here pretty soon where they're having the insured go ahead and do that because there's just
some people don't want somebody coming on their property. They'd rather do that and get it done instead of having to schedule a time or have their dogs go crazy because someone's around. I mean, I think that's a great option.
Yeah.
Cool.
I did quickly do inspection hits of things that you need to look out for. So like some liability hazards, don't want loose or missing railings, No inoperable vehicles. That's kind of the same thing with Fair Plan.
Mm-hmm.
No water damage, like leaking faucets or sinks that are leaking. They do an exterior condition check, like for dry rot or peeling paint. Same thing with Fair Plan. No broken windows.
So basically, a home in good condition. I mean, we're talking about well maintained. I think is the right words, right? You want somebody that's showing pride of ownership.
Pride of ownership, definitely.
Cool.
They do want that 0 to 5 zone. They're pretty new on that too. I mean,
You're
that's
talking about defensible space, so no trees up against the home. What about a fence? We had that conversation before. They're still okay with the fence?
Fencing. I didn't bring that up. That's on me.
Probably a good question, right? Because I think that's where we're headed, right?
Yeah, because a lot of times that fencing is going to be attached to the home. So
yeah, metal, non-combustible, no more wood.
Mm-hmm.
What about composite? Would composite count as non-combustible? Like decks, like Trex decks?
Yeah, the Trex decking is fine.
Okay, so now Trex fencing, same material, right? Same concept.
They just don't want wood piles, mulch, trash, like fencing, anything like that within the 5 foot zone. I think that was kind of their key high level points. So I'll have to bring up the deck. I don't know why. Yeah, I guess I'm human, I'm not going to remember everything.
Well, I've got a conversation on Friday, so I'll bring it up too.
Okay. Yeah, that'd be great.
Awesome. So want to move on to the next topic then?
Yeah.
All right. So you presented this right here. So I know we all got an email, or agents got an email, and I didn't really have the time to look into it in detail, but this was a great topic to go over. So there's some bills that are moving through, and there's a few of them that make sense to help homeowners, right? Sorry, give me 1 second here. I'll let you go over that. Let me just check this message real quick.
Yeah. I know one of the big things that we've talked about before has been that personal property and being able to list out all of the items.
Mm-hmm.
But I guess, sorry, you have the first one pulled up, the Safe Homes Act. So
let me go this one here.
Yeah, the eliminate the list.
Okay.
So that requires insurers to pay at least up to $350,000 or 60% of whatever your contents level coverage is. So if your contents coverage is $500,000, that's probably right at $300,000. I think off the top of my head, math wise. But so if you've got $100,000 in personal property coverage, they're going to pay $60,000 without you having
no questions asked.
Yeah, no questions asked, which is huge. I think, after you have that loss of your home, it's really hard to, oh, geez, what did I really have in my house? Or you're going to miss something. So,
yep. I mean, I have that conversation quite frequently. Take your phone out, walk around your home, get a video of everything you have. It'll make it a lot easier if that comes up, right?
Right. And then gives them 100 days to submit proof of loss for everything.
I would think that in a situation like that, 100 days goes by in the blink of an eye. That's a little over 3 months, but your whole life is upended. So there's so many things going on. I'll go back to the other one.
Yeah. What was the first one again? The Safe Homes Act?
1 second. I'm going to go back. There we go.
Do you want to hit that one up or?
I haven't reviewed it very much at all. I put the slides together, but I hadn't dug in. So I think you're more knowledgeable than I am.
Okay. Yeah, it's basically just the 0 to 5 feet. The zone 0, them being able to help give you money to help you harden your home and make it more fire resilient, essentially.
Mm-hmm.
Forgot how much the actual dollar amount is. I want to say it was up to 10,000.
I'll look it up.
Look it up real quick. Because it's up. I mean, it's just a huge fund that they're going to be utilizing to pay out people. So 40% of the increase is gross premiums tax from property and casualty insurance. So I don't think there's an actual dollar yet that is going to be provided. I think it's just more of a, you're doing the wildfire hardening to your home. We're going to give you a tax credit, and you're going to be able to utilize that as like
And this is specifically for homes in high or very high fire hazard severity zones, right?
no, I think it's for all homes.
Oh, really?
I think. Let me quickly look and see. So you have to actually, so it says you have to be covered by an admitted carrier or the California Fair Plan. You have to be in a zip code that overlaps a high or very high fire hazard severity.
Yeah. So not Sacramento, not Rockland.
Yeah.
Right. You're up in Auburn, Grass Valley. Say that again?
I think that there's some high areas down there.
Yeah. I mean, there's spots here and there, but in general, I don't think it's going to be like all of Grass Valley would qualify, right? All of Nevada City would qualify. All of El Dorado Hills would qualify, which is crazy, but that's what we're seeing.
Yeah.
Cool.
So it's just another option, for insureds to make that step and be able to not have to basically take on all the costs, because there's a lot of low-income families, a lot of low-income seniors as well too, that want to do the work, can't do the work, can't afford to do the work. So
yep,
an option.
We only have 3 slides there on that, or 2 slides on that one. Okay. And then third subject. So have you had any conversations around earthquake and where you're at? I don't see that happening very often in the foothills.
I mean, I've had a conversation with people, but I don't actually have sold any. I think I've gotten 2 policies in all of my almost 10-year career. So I don't write in a lot of earthquake zone areas. But the big one's always coming, right?
Yeah, I think we're overdue is what it feels like. So
how about you?
I quote it occasionally, but no one really takes us up on it in the greater Sacramento area. And then those like in Oakland, in areas like that, the premiums are pretty significant. So, we'll quote it, but I don't see anyone really taking it. What's good is location is key. So this slide was pretty good. I like this one. The greater Sacramento region is a medium risk level. So I would be leaning. So I'm in Rockland. There's rocks. You can't go 3 inches down in the ground without hitting a rock. So I would guess that my area is lower, but maybe there's softer ground somewhere, and that puts it in medium. But the coastal areas, San Andreas Fault, Southern California. I mean, that was what was the big one for them? Was in the 90s, was it? Loma Prieta?
Sounds familiar.
Was it 89?
Yeah, the one by the bay.
Yeah, that one was Santa Cruz area, and then there was another one, Southern California. I can't remember. It was before I lived in California. Large Southern California earthquake. Ridgecrest, 7.1 magnitude. That was 2019. No, Northridge. That was the one I was thinking of. Northridge was the huge earthquake in Southern California. That was in 92.
Okay.
So we're talking pretty long time, right? So
yeah,
I got to think that 1992 to 2025, that's over 30 years ago, right? So yes, I did math on a calculator. I can't do it in my head. But those are a while ago, So
Do you have any on the books right now?
No, I do not. I have no written earthquake policies, which
Someone from LA just sent me that. It was kind of funny that we were chatting about LA earlier, but I somehow got this lead from someone down in LA, and he sent me his fair plan and his earthquake policy and his RAP policy, and his earthquake policy was only like $1,000. I was surprised.
Wow.
For $550,000.
What kind of deductible? 10%?
Oh, great question. Great question.
Does this say you have a $500,000 home? Most of these earthquake deductibles I'm seeing are, on the screen it's 5 to 25, but I see 10 to 20 easy
So
as a default.
It's a 15% deductible.
So let's say it's a $600,000 home in SoCal at 15%. So the earthquake would kick in after $90,000 in coverage. So you're talking, I mean, I don't think that'd be hard to hit with structural damage, but 90 grand.
Yeah, it wants the big one. It's not going to take a small one that, I don't know, may just disrupt your slab or disrupt your foundation, and that causes $100,000. I guess I'm just assuming, a couple $100,000 worth of damage, but it wants you to basically be leveled, it seems like.
Aren't all homeowner policies carriers required to provide an earthquake quote? I feel like that's
yeah, you can it just accept or decline. It's almost like it's just like terrorism on liability policies.
Yeah. So every single person that gets a quote, gets a policy, then receives a quote from the admitted carrier, the fair plan, whatever, offering earthquake coverage, right? So even if your agent doesn't discuss it with you, after your policy is bound, you get documentation with an earthquake quote.
Yeah, they'll send it out in a separate quote saying, "Thanks for signing up. Here's your earthquake quote. Take it, leave it. If you don't reply to us, we're gonna say you decline."
And the great majority of people just don't take it, right?
Yeah.
Okay.
But a lot of them do have that higher deductible. I think that most of them start at 5%.
Every time I see it's like 10 to 20%. So.
Yeah.
All right, next slide. I know we're kind of rapid firing this. It's only been about 25 minutes, but these are the key takeaways, right? Ryan's got a carrier. If you're shopping your homeowner's insurance in the higher fire areas, you're going to want to reach out to Ryan. And then new laws are in. It says being passed, but it's really in process to protect homeowners and simplify claims.
Yeah. And
then just like flood, standard homeowners policies, the HO3 policies do not cover earthquake damage. Doesn't include flood either. Flood and earthquake are completely separate in California from your homeowners policy, unless you have one or two of these rare carriers that allows you to endorse for earthquake damage. And then the best thing you can do is call a local agent, someone that knows your area and knows your need, and have a conversation.
Yeah. How have you been this week? What's been some of your anything interesting on?
We're so swamped. We're probably 25 quotes behind right now, just trying our best to catch up.
Wow.
Seeing a lot of struggles. I know we had a conversation about this before. A lot of struggles with multi residence properties, so habitational properties, especially ones with 6 to 10 different living units. It's been rough. It's been really rough, and there's more and more people asking. I mean, I like to have that conversation that State Farm used to write all of those, and then they non-renewed a whole chunk of them, and policies went from being $1,500 to $2,000 a year to being $8,000 to $9,000 to $10,000 a year for that same property.
Yeah.
So a lot of shock for a lot of multi-unit owners, so apartments, apartment complexes, things like that, and we're struggling to get them placed. E&S or excess and surplus carriers are telling us they have, or brokers telling us they have markets. It's not something we get a quote on instantly, right? It's a longer process to get that information, a lot more underwriting, and again, higher corresponding premiums.
Yep.
What about for you?
I would say that's excess and surplus, and that's kind of what we're going to have to deal with here pretty soon. Is whether it be for your 6 or multifamily unit dwellings, these residential risk, or even just general liability risks. A lot of the carriers that have left have put more strain on them, the excess and surplus lines carriers, for getting things submitted and processed. So
Mm-hmm.
if you're in the insurance store and you're looking to buy something, you're going to have a little bit more patience, because it's going to take longer to get something done.
I got one viewer. We've been on for about half an hour right now.
Okay.
Or almost half an hour.
Yeah.
Anything else on top of your mind you want to go over, or you want to call it early today?
Yeah, we'll probably have to call it early. I can't think of anything else that's really kind of come up this week, other than just a lot of talk. Oh, there's still been a lot of education. There's still a lot of people that are out there and wanting to kind of have their hand held and look for some guidance on how to shop for insurance.
Mm-hmm.
So I think that's why people have been like, oh, well, I can't get a hold of my agent. It's been a day. It's been 2 days. It's because, having to have 20, 30-minute conversations with people and having them understand the insurance market and guide them through it is just taking a little bit longer than what it used to be.
Absolutely. Completely agree with that.
There's a couple people on there. I don't know if anyone has any questions while we're still available for you.
I see 2 on. Let me go look at this channel here. 1 on there, so 3 on. And then on your page on Facebook, we have none. So there's 3 on Facebook. I haven't seen YouTube. I wasn't tracking that. So.
Yeah. Someone asked me too the other day about Fair Plan. They were like, well, now that I'm on Fair Plan, am I not able to go to anywhere else? And that's just it. And it's like, well, you are able to go somewhere else. It depends on if another carrier comes into the market, and then you can move. So I think because there's been a lot more on insureds to kind of take that responsibility of shopping out their insurance, it's key to continually, call agents and see if there's new markets that are developed and you qualify.
Yeah, because you got this new carrier 30 days, 60 days ago, maybe? Not even that far ago.
A week ago.
A week ago. So yeah, there are definitely carriers entering the California market in the excess and surplus space. And if you've got a broker that is looking for markets for you, then you've got a better chance of finding something to get you off the Fair Plan.
Yeah.
Again, there's pros and cons to both, right? There's the Fair Plan is what it is, and then you may pay a little bit more, you may pay a lot less. It really does depend on how that's structured and what type of coverages there are.
Yeah.
Like even you were mentioning that the pool piece, not all carriers will do that. Typically, what I see with admitted carriers, if the pool doesn't meet their requirements, they won't write that policy at all. Where excess and surplus can then exclude the liability for the pool and still give you the homeowner's insurance coverage.
Yeah.
Not the best world, but it's options, right? It's all
yeah,
about
just the fact that there's an
offered.
options instead of a direct no, I think that's huge.
Mm-hmm.
From carriers. But so yeah, the Fair Plan thing, people being able to just, and then even if you go to a non-admitted carrier, now you kind of almost have that safety net of the Fair Plan that if something were to go awry with the other non-admitted carrier or the other one you're with, you can definitely go back. It's a little bit harder whenever you have your lender involved, because then payments are going to start going everywhere.
Yeah.
So that's probably the other hard part too, is the payment issue that I've seen.
Yeah, I've talked to a lot of clients because we've been shopping them a lot in the last 60 days, and they haven't had an issue. They understand that there's a timing because their bank or escrow or impound account has to pay one carrier, get that money back from that carrier, and send money out to the new carrier. It's more of, our office is just making sure we keep on top of that so nothing falls through the cracks, right? We want to make sure to keep that new policy in effect make sure we coordinate payments and get it done.
Yeah. Well, and someone gave me that list of the lenders that weren't taking the difference in conditions payment too, because I've had quite a few of the wrap and the difference in conditions carriers be canceled.
Oh yeah.
So.
Yep. I've gone straight to the clients and they're like, okay, I wasn't expecting this. What are my payment options? And we show them all the payment plans that different DIC carriers have. But yeah, it's I feel like that list is growing, right? Because I've got 1, 2, 3, 4, 5, 6 loan servicers that
Oh,
do
wow.
not pay for that.
That's pretty crazy. 7?
Yep.
You said?
6. I've got 6.
Okay.
On my list, at least. I could be off.
And
Cool,
that's
Ryan. Well, I think that's going to be it for us for today. Call it a
Okay.
little early. Go over the topics, and we'll be back next week Thursday.
Thursday. One person in there. If they had any other questions, now's the time to ask because we are going to be closing it down. But yeah, see you next Thursday.
All right.